So today's cardinal lesson, we're back on income taxes, both federal income tax and state income tax for retirees. So, and how this differs in my previous videos that have been popular about this subject, we've gone over the tax brackets and how we prospectively look at the tax brackets and try to pay, obviously over time, the least taxes, at least federal tax, and then state tax that we can. Today's video really is going to go over what are the taxes, how are your taxes different in retirement than they are when you're working, okay? And there's a lot of similarities, but there's specifically some differences for retirees that when people are coming to us for retirement planning, financial planning, and we write a plan for them, how we're thinking differently about people that are retired than we do people that are working. So we're going to start off, the first point we want to make is the federal income tax on Social Security. So how is Social Security taxed? How is it not taxed? But that's going to be an area, the first area you're going to look at on your tax return is how much tax am I going to have to pay on my Social Security check? And one simple rule of thumb that I can give you is if you have no other income besides Social Security and you have to live just off of that, then you're probably not going to pay much tax at all. Because the way Social Security federal income tax is calculated, it's based upon your other income. It's based upon the amount of income besides Social Security that you have, or taxable income. That drives the percentage of your income that's from Social Security that's taxable. So, and there's a formula for that, which we're going to save you that. I actually have another video that outlines that formula. But when you get done plugging all your numbers into the formula, and we'll do this for you, is you're going to be from 0 to 85% of your Social Security taxable. So people that have high incomes in retirement, they're going to pay taxes on 85% of their Social Security check. Or another way to look at that is if you have a high income, 15% of your Social Security check is still going to be tax-free. So you're going to get a little piece of your Social Security tax-free, and then 85% of it then will be taxable. So, I mean, it's kind of that simple. Now, then you've got to look at state income tax on Social Security, is that most states exempt Social Security from their income tax. So unless you live in one of these states, and there's 12 of them, your Social Security check is exempt from state income tax. And you know, it's kind of interesting. If you look at California, California does have a state income tax, and it's really one of the highest, or it's the highest in the land. California does not tax Social Security as income, so it's exempt. So these lists of states, but just so you understand, you're going to have to pay federal tax and you're going to have to pay state income tax on your Social Security if you live in one of these states. And that's generally going to be based on a formula so that the people that have only Social Security, or people that have only Social Security and a little bit extra, aren't really going to pay much taxes at all, okay? Now, you get an increased standard deduction for being over 65. So if you're a couple and both of you are over 65, you're going to get an increase of $2,800 in the standard deduction. And most people filing income taxes anymore, including me, are taking this standard deduction of $25,100 a year, where I don't have to keep track of all the stuff anymore. I mean, home mortgage interest and charitable contributions and taxes that you pay on your real estate, and you just add up all those things that were deductions. You don't have to keep track of that. You can just put down on your return $25,100, and it's been this way for 3 or 4 years. If you're over 65 and you're a couple, you get to add $2,800 to that. For a single person, the standard deduction is $12,550, and if you're 65 plus, you get to add $1,750 to that. So that's another way to calculate tax-free income, and there is a difference in retirees and people that are younger. Okay, then you have to concern yourself with this Medicare tax, which is called IRMA. That's an acronym. Income-related monthly adjustment amount, which is really kind of interesting that all these new terms developed. It's an acronym from Medicare, and what it really is the Medicare tax. And that's going to be assessed upon you if your annual income or annual taxable income is $91,000 a year or more. So that's the threshold. People under 90 grand and they're single, they don't have to worry about paying extra money or a tax on their Medicare. And for couples, that's $182,000 a year of taxable income. IRMA is pretty substantial, and it's a cliff thing. So once you're over that, $1 over it, you're going to pay, and then those numbers go up to about $500,000, $600,000, $700,000 a year of different thresholds, and then you're going to be paying a substantial amount for your Medicare if you're over that. So call it a tax, call it a surcharge, whatever it is, I'm going to call it a tax. Now, when we get into federal income taxes, what I want to show you is just one of the bracket levels for married and single here, because this comes up quite a bit in our planning, because many of our clients coming into us, they've really only got 2 sources of income, some of them 3 sources of income. And those sources are, number 1, which I went over first, their Social Security check. And number 2 is withdrawals from their retirement account, or either their 401k or their IRA. And that's going to create taxable income. And what's interesting is that money is within your control. In other words, you're able to make those withdrawals out of your retirement account on a year-by-year basis at your discretion. So if you wanted to have a low income year and you could afford to do this, you would only take less out of there. If you had a high income year, or you wanted to have a high income year, or you needed the money for something, you can make those withdrawals at your will. So we have many people that have accepted in retirement that are single or married. 22% is the highest level of federal income tax that they want to pay. And so we can work around their income and come up with their IRA withdrawals to be at a point where we withdraw just up, it's close to 90 grand a year, is if that's what your taxable income, the most you're going to pay is 22% on the top levels. For a married couple, that's $178,000. Now, we also have people doing this where they're planning around this for Roth conversions. So they're saying, this is an acceptable tax rate. My income is a little bit less than this, or substantially less than this. I'm going to convert over to a Roth an amount to bring me right up to this. Now, the next bracket is really not too bad. It's 24%. And for a single, that's about $170,000. For a married couple, it's about $340,000 in 2022. So we do all this type of planning and tax planning to actually voluntarily raise a person's level of income tax up to an acceptable level, and then pay the taxes, but now we're either going to convert it into a Roth or just move it over into their savings or do it as a distribution or a withdrawal. Then you have state income taxes, and there is no state income tax in these states: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming. And so a lot of you already know this, and especially you people that live in Florida. There's a whole lot of people that are retired that retire to Florida, but they still have a home back in their summer residence, and they spend the winter down in Florida, but they're going to spend 6 months and a day in Florida. So that's their residence, and they can pay no state income tax to Florida. And if their home state has an income tax, but they live there less than half the year, many times they can get out of that. We have a number of people that intentionally move to one of these states just so that they can have no state income taxes. These can be quite substantial. And then in retirement, of course, you're still going to need to pay real estate taxes and all those local taxes on the value of your real estate. And then you've got sales tax, which in most states is pretty substantial. So just wanted to have a discussion about how your taxes are different in retirement, how we look at it. I'm Hans Scheil, and I thank you for listening.